Welcome to the deep dive. Today we're cutting through the hype, really digging into one of the most compelling ideas in crypto, maybe one of the most misunderstood too, decentralization. We've all heard the promise, right? This idea of absolute freedom, a peer-to-peer revolution, freeing us from banks, from the usual gatekeepers, offering things like immutability, censorship resistance, real financial independence. It just sounds like
Hmm.
this whole new digital frontier where power is truly spread out.
It is a powerful vision, no doubt about it. And I think for a lot of people involved in crypto, that promise, breaking free from central control, that's been the North Star. But what's really fascinating and maybe a bit uh, sobering is how often the actual reality, how these systems work in practice, it stands in pretty stark contrast to that founding ideal. Tim O'Reilly, who's seen waves of tech come and go, he put it quite bluntly. He said, blockchain turned out to be the most rapid re-centralization of a decentralized technology that I've seen in my lifetime.
Hmm.
And that's what we're going to explore today.
What some economists, folks at the Bank for International Settlements, the BIS, they aptly termed the decentralization illusion.
The decentralization illusion. Wow, that's a strong phrase, especially when, like you said, so much marketing, so much of the narrative
Yeah.
is built around decentralization. So you're saying it's not really black and white, not just, decentralized or centralized. It's
Right.
more like a spectrum.
Exactly. It's definitely a spectrum. And when you really look closely, most of the major crypto projects, despite the strong claims, they often land much closer to the centralized end than people might think. And look, it's important to say this isn't always about bad intentions or some conspiracy. Often it's just driven by really powerful economic forces, things like economies of scale, and also the demand for user convenience. People want things to be easy, right? And frankly, the huge challenge of coordinating lots of people to build something this complex. So our mission in this deep dive is to really unpack this illusion. We'll look at specific examples across three key layers. First, the consensus layer, that's the absolute core, how the network stays secure. Then the governance layer, how decisions get made. And finally, the infrastructure layer, basically how we all actually interact with this stuff. And you'll see, I think, how at pretty much every level, new kinds of centralization have sort of crept back in, bringing back the very intermediaries the whole thing was supposed to get rid of.
Okay, let's unpack this then. Starting right at the bottom, the foundation, the consensus layer. This is where the security happens, right? Where that whole promise of a trustless environment really starts. And for Bitcoin, the original, Satoshi's vision, well, it sounded so simple, so elegant. One CPU, one vote. That sounds about as decentralized as you can possibly get, doesn't it? Everybody chipping in with a regular computer, a level playing field.
Yeah, that ideal one CPU, one vote, it certainly held true. But really only in the very, very early days when Bitcoin was just this niche thing for hobbyists. Back then, you really could mine effectively with a standard CPU. But the reality now, with Bitcoin's proof of work, or POW, it's totally transformed. It's now a highly industrialized, extremely capital-intensive global industry. It's not hobbyists anymore. And this relentless push for economies of scale in mining, it's not just about being efficient. It's a fundamental economic force that actually pushes against that one CPU, one vote idea.
Right.
It naturally concentrates power. You need specialized, super high-performance hardware now, these ASICs, application-specific integrated circuits. And these things, they don't just cost a lot, they consume enormous amounts of electricity. Energy is the single biggest running cost.
Right. Okay. So if electricity is the main cost, that creates a huge incentive for miners, doesn't it? They're going to go where the power is cheapest. What does that do to the network's layout, its decentralization?
Well, it does exactly what you'd expect. It leads to this significant geographical clustering of mining operations. It's like any resource extraction industry, you go where the resource is cheapest or most abundant. So miners flock to places with cheap power. And the data backs this up. For instance, there was a stat from March 2023. Pretty startling. Just 34 mining facilities located in the U.S. and controlled by only 22 different companies, they accounted for roughly one-third of the entire global Bitcoin hash rate.
One-third from just a handful of places run by even fewer entities.
Exactly, one-third. So think about that. That's not some widely distributed, resilient global network of individuals. It creates these massive jurisdictional risks. What happens if regulations change significantly in that one region, or even a major power outage? It could seriously impact the whole network's security.
And that's just the physical location. What about how they organize? We hear about mining pools all the time. Is that another layer where power gets concentrated?
Absolutely. Yeah. Mining pools exacerbate this concentration significantly. See, an individual miner, even with powerful hardware, might go a long time without actually finding a block and getting the reward. It's unpredictable. So to get a more steady, predictable income, they pool their computing power, their hash rate, together. Now, this makes mining viable for smaller players, sure, but it also means these massive virtual clusters of power emerge, all controlled by just a few pool operators. And these operators, they're the ones who actually choose which transactions go into the blocks they mine. That gives them real, tangible influence over the network. And the numbers are, again, pretty stark. As of March 2024, the two biggest pools, Foundry USA and Antpool together, controlled about 51.6% of the global Bitcoin hash rate.
Whoa, 51.6%.
Yeah.
That's hovering right around that critical 51% threshold we always hear about for a majority attack where someone could potentially block transactions or double spend. That sounds incredibly risky.
It is theoretically very risky. That 51% number isn't arbitrary. It represents the threshold where, in theory, a coordinated group could execute such attacks. They could potentially prevent specific transactions from ever getting confirmed, or halt payments between certain users, or, the big one, revert their own transactions after they appear confirmed the double spend. We actually saw a glimpse of this risk back in 2014. A pool called ghash.io briefly crossed that 50% threshold.
Right, I remember that. There's a lot of panic.
There was. It caused significant alarm in the community. Now, Ghash voluntarily reduced its share, and a full-scale attack didn't happen. And, there's a strong argument that it's not in the economic self-interest of large pools to attack the network. Why? Because doing so would destroy confidence in Bitcoin, crash the price, and ultimately devalue their own massive investments in mining hardware and the Bitcoin they hold. It's a kind of mutually assured destruction, economically speaking.
So it's game theory holding it together, basically, relying on the rational self-interest of these big players not to kill the golden goose.
Pretty much. It's a balance based on economic incentives, which, you could argue, is a subtle step away from the original ideal of purely trustless security based only on distributed consensus. We're trusting their economic rationality.
Okay, so the pools are one concentration point. But you also mentioned the hardware itself. I vaguely recall something about a potential kill switch in miners. That sounds, well, completely counter to the whole idea.
That's right. Even the physical hardware introduces centralization. The market for these specialized ASIC miners is dominated by just a handful of manufacturers. Bitmain has historically been a huge player. And this brings us to the ant bleed incident in 2017. This was essentially a hidden backdoor found in the firmware of Bitmain's Antminer devices. This backdoor would have allowed Bitmain, the manufacturer, to remotely query and potentially shut down a huge percentage of the world's Bitcoin mining hardware.
A remote kill switch controlled by one company.
Effectively, yes. Imagine buying equipment for a supposedly decentralized network, only to find out the manufacturer holds a secret off switch. It was a massive wake-up call. It showed that network security isn't just about how hash rate is distributed statistically. It also depends heavily on the integrity and the control exerted by a very small number of hardware makers, a vulnerability at the manufacturing level.
Wow. Okay, that really paints a picture of how Bitcoin's reality drifted from that one CPU, one vote dream. But then came Ethereum's big move, the merge, switching to proof of stake.
Yeah.
Many people saw POS as the answer, right? More sustainable, maybe more decentralized because you didn't need the crazy hardware and energy. Did it actually fix these centralization issues, or did it just shift the problem?
It didn't eliminate centralization. It fundamentally just changed its form. Instead of power concentrating around computational hardware and cheap energy, proof of stake, or POS, concentrates power around financial capital. To be a validator in Ethereum, to participate in securing the network and earn rewards, you need to stake a minimum of 32 ETH.
Which is a lot of money for most people.
Exactly. At current market prices, that's a very significant financial barrier. It immediately excludes a vast number of potential participants and naturally favors wealthy individuals, institutions, large holders of ETH. And just like with mining, this high barrier inevitably led to the rise of staking pools and centralized staking services. People want the yield, but can't meet the 32 ETH minimum or handle the technical side.
So history repeats itself. We get pools again, but for staking this time. Creating convenience, but also new central points.
You're seeing the pattern, right? And among these staking solutions, liquid staking protocols have become incredibly dominant. These protocols are clever. They let you stake any amount of ETH, not just multiples of 32. In return, you get a token, a liquid staking token, or LST, that represents your staked ETH plus accruing rewards. The key is liquid. You can trade this LST, use it in DeFi, so your capital isn't totally locked up. Huge convenience factor.
Yeah.
But this convenience has led, yet again, to massive concentration. One protocol in particular stands out, Lido. As of August 2024, Lido controlled approximately 28.55% of all ETH staked on the Beacon chain.
Okay, nearly 30% in one protocol. What's the danger threshold in Ethereum's POS? Is it like Bitcoin's 51%? And what does Lito's dominance mean practically?
The critical threshold often cited for Ethereum POS is 33%. The Ethereum Foundation itself has stated that an entity controlling one-third of the total staked ETH could potentially prevent the chain from finalizing,
Prevent finalization, meaning
meaning they could stop new blocks from being irreversibly added to the chain, effectively halting the network's progress, causing major disruption. And Lido has been perilously close to this threshold. In fact, at times, its share has nudged above 32%. What's perhaps even more revealing is that there was a governance proposal within Lido's own community to limit its market share, to self-cap its growth to mitigate this systemic risk.
yeah.
And Lido's token holders voted it down. They explicitly chose not to self-limit. They prioritized continued growth, market dominance, and the associated protocol revenue over reducing the potential risk to Ethereum's decentralization and security.
That really highlights the tension, doesn't it? The protocol's own success potentially undermining the network it relies on.
It absolutely does. And on top of Lido, you have major centralized exchanges becoming huge staking players. Coinbase, for example, stakes around 11.42% of all ETH through its platform. Binance, through its own liquid staking token, holds around another 10%. So users are literally handing their ETH back over to these large, regulated, centralized companies to stake it for them. This reintroduces custodial risk, counterparty risk, the very things crypto aimed to solve. You're trusting Coinbase or Binance not to get hacked, not to misuse funds, not to be compelled by regulators. It's convenient, but it's a far cry from self-sovereign staking.
So it really feels like whether it's POW concentrating mining power or POS concentrating capital, these powerful economic forces and the simple desire for ease of use just keep pulling things back towards the center. It seems almost inevitable. What about projects where maybe the centralization wasn't an accident, but more of an upfront design choice, a deliberate trade-off made for, say, performance? Is there a good example of that?
Absolutely. And it's a really important case study. The BNB chain, which most people probably knew as Binance Smart Chain or BSC, is a perfect example of deliberate strategic centralization. It wasn't something that happened gradually, it was baked in from the start. They made a very clear trade-off. Sacrifice decentralization to achieve high transaction speeds and super low fees, specifically aiming to attract users frustrated with Ethereum's congestion and high gas costs at the time. And it worked, didn't it? It grabbed a huge chunk of the market very quickly.
It did. It showed just how powerful that demand for performance and low cost is. It can easily act as this gravitational force pulling towards centralization, often overriding those core ideological commitments we talked about. It proved that for many users, cheap and fast trumps ideologically pure.
So how exactly did they achieve that performance? If it wasn't some tech breakthrough, what was the magic of centralization, as that quote put it? Well, BNB Chain uses a consensus mechanism called proof of staked authority, or POGANE. It's a hybrid model. It combines elements of proof of stake with proof of authority. Proof of authority is inherently more centralized because it relies on a set of pre-approved, known validators.
Yeah.
It's permissioned. You can't just join, you have to be chosen or approved. This immediately moves away from the trustless open competition model. Specifically, the BNB chain network is secured by a very small, permissioned group of only 21 active validators.
21, compared to thousands on Ethereum.
Exactly. A tiny number, and it gets even more centralized. Those 21 active validators, they are chosen daily by an even smaller group. Just 11 validators from the related but separate Binance chain. So you have a very small group selecting another very small group to run the network.
That sounds incredibly tight-knit, almost like, I don't know, a private club running the blockchain rather than a decentralized public utility.
It does have that feel. And many analysts and critics have pointed out, quite reasonably, that it's hard not to assume these validators are closely linked to, or at least heavily influenced by, Binance itself, the company. There's also evidence suggesting the block production might follow a more predetermined order than a purely random or state-weighted selection, which again points towards a high degree of central coordination. That quote you mentioned from Ryan Watkins at Masari really nailed it. BSC's performance advantages are not due to technological innovation. It's the magic of centralization. BSC is an Ethereum fork with a centralized validator set. That's it, nothing more. And this raises really serious questions about things like censorship resistance. If a single company, Binance, effectively controls the validator set, what stops them from potentially freezing assets or blocking transactions if pressured by a government or for their own commercial reasons? It shows how quickly the ideal can be traded for market share.
That's a stark example of the trade-offs. Okay, so we've talked about the technical layer, the consensus, but what about the human layer? How decisions get made about the future of these protocols? Bitcoin, again, is often held up as the ideal here. No formal leadership, right? No CEO, no foundation pulling the strings. Sounds like genuine decentralization and governance. But is that too an illusion?
It is, largely. The absence of a formal structure in Bitcoin doesn't mean there's no leadership. It just means the leadership is informal and arguably less accountable. What's happened is that this power vacuum has effectively been filled by a small, rather insular group. These are the highly skilled software developers who maintain Bitcoin Core. Bitcoin Core isn't the only Bitcoin software, but it's by far the dominant one, the reference client most miners and nodes run. Now, their work is open source, anyone can scrutinize it, anyone can propose changes, but in practice, their deep technical expertise, their long history of the code base, it grants them enormous influence. They aren't just, code janitors. They function as the primary architects and effectively the de facto policymakers for Bitcoin. It's centralization by expertise, you could say.
So, because it's so complex and they're the ones who really understand it, their opinions just carry vastly more weight. It's hard for anyone else to challenge them effectively.
That's the crux of it. The practical difficulty of challenging their technical decisions or of successfully launching and gaining adoption for a competing version of the software, a fork, is immense. It means this core group holds what some have called a veto-ish power. Their collective decision on which code changes to merge into the main branch or which ones to reject effectively sets the development agenda for the entire multi-billion-dollar network. They wield significant soft power, shaping what Bitcoin is and what it can become, often through highly technical debates that are inaccessible to most users.
Can you give an example where a decision by this small group really caused waves, showing their influence goes beyond just bug fixes?
Yeah, a really good recent example is the whole debate around op-return limits. Op-return lets you embed a small amount of arbitrary data in a Bitcoin transaction. When the core developers effectively allowed for larger data embedding, facilitating things like ordinals and inscriptions, basically, NFTs on Bitcoin, it ignited a huge philosophical battle.
Right. The is Bitcoin just money or something more debate.
Exactly. One side argued this opened up valuable new use cases for Bitcoin. The other side argued passionately that it was fundamentally changing Bitcoin's purpose, turning it from peer-to-peer electronic cash into a general data storage layer, potentially causing network bloat or spam. It got quite heated. Samson Mow, a well-known Bitcoin proponent and CEO of JN3, went so far as to say Bitcoin Core had become a risk to Bitcoin, and even called for potentially forking the software away from the core developer's direction. So you see how a seemingly technical adjustment made by this core group can have profound policy implications and deeply divide the community, touching on the very identity of Bitcoin.
Fascinating. So even with no formal structure, power concentrates. Okay, what about the flip side? Ethereum does have a formal body, the Ethereum Foundation. Does having that central entity help with decentralization, or does it just make the centralization more obvious?
Well, the Ethereum Foundation, the EF, is definitely a crucial player. It's a nonprofit based in Switzerland, and its role is to coordinate research, fund development through grants, and generally guide the protocol's roadmap. Think big upgrades like the merge. While its mission statement is all about supporting the ecosystem and fostering decentralization, its mere existence, its funding power, and its influence on the technical direction undeniably make it a powerful centralizing force. It's a sort of necessary pragmatic centralization, perhaps, for coordination.
How does that influence play out? Is it just setting the tech roadmap, or is it more than that? Financial influence, too?
It's definitely more than just tech. The EF controls a very substantial treasury. As of late 2024, it was reportedly close to $1 billion, mostly held in ETH. How they manage and spend that money, which projects they fund, which research avenues they pursue, inevitably shapes the ecosystem. It can have real market impacts. For instance, there was some controversy recently when the EF started strategically deploying some of its treasury into DeFi protocols like MEV to earn yield.
Oh, interesting. Why was that controversial?
Well, some critics argue that the EF, as a supposedly neutral steward, shouldn't be actively participating in the DeFi market in a way that could be seen as picking winners and losers among different protocols, should the foundation be playing the market it oversees. But beyond the treasury, academic research actually suggests that even projects aiming for decentralization often meet entities like the EF. They're crucial for effective coordination, for resolving disputes, for pushing forward major upgrades, especially early on. The trend seems to be towards establishing these foundations earlier, which kind of acknowledges their practical necessity. But again, this coordination comes at the price of concentrating significant power and agenda-setting ability within the EF's leadership and research teams.
And I guess no event highlights the EF's role and maybe the limits of pure code-based governance better than the DAO hack back in 2016. That was supposed to be the ultimate decentralized organization run purely by smart contracts, right? Code is law.
Exactly. The DAO was this groundbreaking experiment, a venture fund, but with no managers, no board, just code executing on the Ethereum blockchain. Investors bought DAO tokens, giving them voting rights on which projects the fund would back. The mantra was absolutely code is law. But then an attacker found a vulnerability, a loophole in that code, and started draining funds. Around $60 million worth of ETH at the time, which was a staggering 14% of all ETHs in circulation.
14%. That must have been an existential crisis for Ethereum itself.
It absolutely was. The whole network's future was potentially on the line. And this is where the code is law principle shattered against harsh reality. The Ethereum community, with Vitalik Buterin and the core developers associated with the EF taking a leading role, faced a huge dilemma. Do they let the law of the code stand, even if it means disaster? Or do they intervene? They proposed a hard fork, a fundamental change to the Ethereum software itself, a backward incompatible upgrade. The purpose? To essentially rewrite the blockchain's history, rolling it back to before the hack and returning the stolen funds to recovery address.
Rewriting history. That sounds like the absolute antithesis of blockchain's promise of immutability. How did the community react? Was it truly a community decision or was it pushed through by the leadership?
It was incredibly controversial. A massive debate erupted. On one side, people argued that immutability was sacred. Changing the ledger undermined the entire value proposition. Code is law means you accept the consequences, good or bad. On the other side, people argued that letting the theft stand would cripple Ethereum, potentially killing the project, and that the intent of the code was clearly not to allow this theft. Pragmatism versus principle. Ultimately, after intense debate and signaling from miners and node operators, the vast majority of the network participants agreed to implement the hard fork. The DAO hack became this pivotal moment. It proved quite dramatically that when the strict law of the code leads to a result perceived as catastrophic, a relatively small group of highly influential leaders, the core devs, the EF, Vitalik, could successfully rally the majority of the network to change the rules. It showed that blockchains aren't just code, they are socio-technical systems. Human consensus and intervention can, and sometimes do, override the code. And the original chain, the one where the hack wasn't reversed, it still exists as Ethereum Classic ETC. It stands as a sort of living monument to that ideological split, a testament to the moment pragmatic intervention won out over purist principles.
That's a powerful story about where the ultimate authority lies. Okay, one last piece on governance. A lot of the early crypto ethos was about sticking it to the man, bypassing Wall Street and Silicon Valley VCs. But it feels like VCs are now everywhere in crypto. Have they managed to re-centralize influence through funding?
Oh, absolutely. That initial rebellious spirit, the idea of open participation, where anyone could buy into a project early just by getting the token, that has significantly shifted. The industry has been, you could say, embraced or perhaps co-opted by the very venture capital firms that initially aimed to disrupt. Now, this flood of VC money has undeniably fueled incredible innovation. Let's be clear, a lot of the tech we see wouldn't exist without it. But it absolutely comes at the cost of reintroducing those traditional power dynamics. How? Well, VCs don't just provide capital. They structure deals that concentrate power and wealth. Think large token allocations given to founders and early investors before the public even gets a chance. These allocations often come with long lockup periods, but they represent huge potential wealth and, crucially, governance power down the line. VCs often get board seats or advisory roles, giving them direct influence over projects' strategic direction. And they negotiate favorable investment terms, better prices, specific rights that simply aren't available to retail participants buying tokens on an exchange.
Can you point to a specific example? A major project where this VC influence and token concentration is really apparent, maybe impacting its decentralization claims.
Solana is often cited as a prime example here. Its incredibly rapid growth and ecosystem development were significantly bankrolled by major VC firms, with Andreessen Horowitz, A16z being a very prominent backer, among others. This heavy early investment led to a situation where a substantial portion of the native SOL token supply was, and likely still is, concentrated in the hands of these early investors and the core team. Why does that matter for decentralization? Because in many proof-of-stake systems, and particularly in governance votes, token holdings often equate to voting power. If a small group controls a large chunk of the tokens, they can heavily influence or even dictate the outcome of governance decisions, steering the network's future.
So it becomes less about community consensus and more about consensus among the largest shareholders.
Precisely. It shifts the power dynamic. And this isn't unique to Solana. It's a widespread trend. Many, if not most, major new blockchain projects launched in recent years have significant VC backing. They're often structured from the outset to appeal to these institutional investors, creating, in effect, a new class of gatekeepers. Power isn't determined by community contribution or running a node anymore. It's often determined by who got in early with the big checks. It's a re-centralization through finance, mirroring the traditional world.
Okay, so we've hit consensus and governance and seen centralization creeping in everywhere. Now, what about the infrastructure layer? How we as users actually connect to and use these blockchains day to day? Web3 promises all this resilience, censorship resistance, user sovereignty. Does that promise hold up when you look at the pipes and wires connecting everything? Is the user experience truly decentralized?
Yet, this is where the illusion can be particularly strong, because the underlying blockchain might be decentralized, but our access to it often isn't. The infrastructure layer reveals just how much the decentralized ecosystem is often built on top of surprisingly fragile, centralized foundations. For the vast majority of users, interacting with a blockchain, checking your balance, sending a transaction, using a dApp, it's not a direct peer-to-peer connection to the network. Instead, it's almost always mediated by a stack of centralized services. These services provide essential convenience, they make things usable, but they do so at the cost of reintroducing single points of failure and control. Think of them as the necessary on-ramps and off-ramps, but those ramps are often owned by single companies.
Okay, give us an example. What's a piece of this centralized infrastructure that most of us use without even realizing it?
The absolute classic example here is Infura. Most regular Ethereum users have probably never heard the name Infura. Yet it's arguably one of the most critical and centralizing pieces of infrastructure in the entire Ethereum ecosystem. What Infura does is provide developers with easy access to Ethereum nodes through an API. Running your own Ethereum node is technically complex, requires significant bandwidth, storage, and uptime. It's a hassle. Infura solves this. Developers can just query Infura's nodes instead of running their own. This convenience has made it the default, almost invisible backbone for a huge number of Ethereum applications, websites, and especially wallets. Most notably, MetaMask, the most popular Ethereum wallet, uses Infura as its default service provider to fetch balances and broadcast transactions to the network.
So if I'm using MetaMask, I'm likely talking to Infura, not directly to the Ethereum network itself, creating a massive dependency on this one company.
In the default configuration, yes. Billions of requests go through Infura daily. And this isn't just a theoretical risk of centralization, it's a risk that has materialized multiple times. On November 11th, 2020, there was a major Infura outage. What happened? Many popular Ethereum services suddenly ground to a halt. Major crypto exchanges like Binance had to pause withdrawals of ETH and ERC20 tokens. MetaMask users couldn't see their correct balances or send transactions reliably. Wallet Connect had issues. DeFi dashboards went blank. It was chaos.
Wow. One service goes down and a huge chunk of the decentralized web stops working.
Precisely. And it happened again. Another significant outage on April 22nd, 2022 caused similar widespread problems for MetaMask and other services relying on Infura. It starkly demonstrates that even if the underlying Ethereum blockchain is running perfectly fine and decentralized, if the main doorway everyone uses gets blocked, the effect for the user is the same as if the network itself were down. And the centralization goes even deeper. Where does Infura run its servers? Primarily on Amazon Web Services, AWS.
Of course. So the decentralized web is largely running on Amazon's centralized cloud.
To a significant extent, yes. This means a major AWS outage in a key region, or even a hypothetical decision by Amazon to restrict services to blockchain companies, could have catastrophic ripple effects across the entire ecosystem that relies, knowingly or unknowingly, on services like Infura. It's centralization layered on centralization.
That's a sobering thought. The foundation isn't as solid or as distributed as it seems. Okay, what about the code itself, the actual software blueprints for these blockchains? Surely that's open and decentralized.
Well, the code is typically open source, yes. But where that open source code is stored, developed, and collaborated on, that's another critical and often completely overlooked point of centralization. The overwhelming majority of cryptocurrency projects, including the big ones like Bitcoin Core and Ethereum's clients, host their code repositories on GitHub.
GitHub, owned by Microsoft.
Owned by Microsoft, yes. So think about it. We have the source code for potentially the future of finance. These systems designed to be censorship-resistant and globally accessible, concentrated on a single, privately owned platform. A platform operated by a U.S. tech giant, subject to U.S. laws, regulations, and political pressures.
And that concentration creates real risks, right? It's not just theoretical. Could access to that code actually be cut off?
It's not theoretical at all. We saw a very clear demonstration of this risk with the Tornado Cash sanctions in 2022. Tornado Cash was a privacy protocol on Ethereum. When the U.S. Treasury Department sanctioned the protocol, what happened almost immediately? GitHub suspended the personal accounts of the core developers contributing to Tornado Cash. And crucially, it removed the project's source code repositories from its platform.
They just deleted the code.
They took down the public repositories. Now, the code likely existed elsewhere, but the primary hub for collaboration and access was shut down overnight. This event showed, without a doubt, that access to the foundational code of a supposedly decentralized and censorship-resistant protocol could be instantly cut off by a corporate decision, likely driven by a government mandate. The very blueprints for building and running these systems are vulnerable to centralized control points. Now, are there alternatives? Yes. Decentralized code collaboration platforms like Radical and Gcopia are emerging. They use peer-to-peer networking, trying to build censorship-resistant alternatives to GitHub.
But are people using them?
That's the challenge. They face an enormous uphill battle to gain adoption. GitHub has massive network effects. Developers are used to it, the tooling is mature, collaboration is easy. Overcoming that inertia, that convenience factor, is incredibly difficult, even for developers who ideologically support decentralization. Convenience often wins again.
It seems to be the recurring theme. Okay, last stop. The user experience itself. For the everyday person holding crypto, the mantra is always, not your keys, not your coins. True self-sovereignty, being your own bank. Is this finally the one area where decentralization holds true, where users genuinely have control, or is that ideal also compromised in practice?
Well, the ideal of self-sovereignty is central to the crypto ethos, and that phrase, not your keys, not your coins, is repeated constantly for a good reason. It highlights the potential to truly own and control your digital assets. However, the reality for the vast majority of crypto users is quite different. Most people opt for the convenience and familiarity of custodial services. Think about how most people first buy Bitcoin or Ether. They go to centralized exchanges like Coinbase, Binance, Kraken. These platforms are the main on-ramps, and very often users just leave their crypto sitting on the exchange. These exchanges then act as de facto custodians, holding billions, perhaps trillions of dollars worth of assets on behalf of their users.
Just like a bank holding your money.
Exactly like a bank. They offer a user-friendly interface, easy trading, sometimes even yield products. But this convenience comes at the direct cost of giving up control and reintroducing counterparty risk. What does that mean? It means you are vulnerable if the exchange gets hacked, and major exchanges have been hacked. You're vulnerable if the company mismanages funds, like we saw with FTX. You're vulnerable if the company goes bankrupt. You're vulnerable to account freezes or seizures mandated by governments. The promise of being your own bank is immediately traded away for the ease of using a familiar bank-like service.
Okay, but what about people who do take the step towards self-custody? People who buy a hardware wallet, like a Ledger or a Trezor, specifically to hold their own keys offline. Surely they have achieved true decentralization and sovereignty.
They are certainly much closer to the ideal. And using a hardware wallet is a major step up in security and control compared to leaving coins on an exchange. But even here, subtle dependencies often remain. Think about how you manage that hardware wallet. You typically use software provided by the manufacturer Ledger, Live for Ledger, Trezor Suite for Trezor. These software applications, they often rely on the company's own servers for things like checking balances, getting transaction histories, and crucially, for firmware updates to the device itself.
Oh, okay, so the device needs updates, and those come from the company's centralized server.
Correct. And in their default settings, these software interfaces also often rely on the company's nodes, or services like Blockstream's Explorer for Bitcoin, or indeed Infura-like services for Ethereum, to actually broadcast your signed transaction to the network. So you might sign a transaction completely securely and offline on your hardware device, which is great. But then the message still often passes through a centralized software layer run by the hardware wallet company to actually reach the decentralized blockchain. Now, is complete sovereignty possible? Yes, technically. You can run your own full Bitcoin or Ethereum node, connect your hardware wallet directly to your own node using intermediary software like Electrum Personal Server or Sparrow Wallet, manage everything yourself without relying on any third-party servers.
But that sounds complicated.
It is complicated. It requires significant technical know-how, time, and resources. It's realistically beyond the reach or, frankly, the interest of the average user. So, again, for the vast majority, even those using hardware wallets, there's a trade-off. They accept some reliance on the manufacturer's centralized infrastructure for the convenience of a smooth user experience. Absolute decentralization remains an elusive ideal, often sacrificed on the altar of usability. So when you step back and look at all the evidence we've gone through, from consensus to governance to the infrastructure we use every day, the picture becomes pretty clear, I think. And it's consistent. That initial powerful promise of a fully decentralized digital world, it's been systematically compromised, maybe tempered is a kinder word, by the hard realities of economics, the practical needs of governance, and the fundamental requirements of building usable infrastructure.
We see it in the industrial scale of Bitcoin mining, the rise of these staking oligarchies in Ethereum POS, the undeniable policymaking power that ends up concentrating in core developer teams, and this pervasive systemic reliance on centralized services like Infura for access or GitHub for code. That decentralization illusion really is everywhere.
Yeah, it really does sound like at every single layer, these incredibly powerful forces are just constantly pulling things back towards the center. You mentioned economics, the need for human coordination, and just sheer user demand for convenience. It's less like a series of flaws and more like an inherent, almost like a law of gravity for these systems.
That's a great way to put it, a gravitational pull towards centralization. And because of that, most major crypto projects don't really exist as these purely decentralized, trustless utopias that the marketing sometimes suggests. Instead, they operate in a state of what we could probably call pragmatic centralization. It's a compromise, a reality that's often quite fundamentally at odds with the public ethos, the revolutionary narrative. Now, does this mean the technology is useless or has no value? Absolutely not. Blockchain, crypto, they are potentially transformative technologies. But it does mean we need to understand their true nature with a lot more nuance, a lot more clarity, and maybe a bit less hype. Acknowledging these centralizing tendencies, understanding where they come from, it isn't about being cynical or dismissing the tech. It's actually the essential first step if we want to build a genuinely more resilient, more honest, and ultimately a more impactful ecosystem for the future. It's about seeing clearly what is, not just what we wish there was. So, okay, we've laid out the problem, the illusion. What does this all mean for you listening to this, trying to make sense of this complex space? How can you navigate it? Well, the insights from this deep dive, they actually give us a kind of framework, a way to assess projects more critically, with a more realistic lens, perhaps. So for you, if you're an investor or just a user trying to understand a project, first, look hard at the consensus layer. Don't just accept the label POW or POWS. Dig deeper. How distributed is the hash rate, really? Or the staked capital? Is any single pool or any single staking provider like Lido getting worryingly close to a critical control threshold at 51% for POW or 33% for PO? Look for the concentration. Second, investigate the governance. Who is really making the decisions? How much influence does the core development team have? Is there a powerful foundation involved? Who funds the development? How are big changes actually proposed, debated, and approved or rejected? Is it transparent? Is power concentrated? Third, scrutinize the tokenomics. This is crucial. What percentage of the total token supply was allocated early on to the team, to advisors, and especially to VCs and other private investors? Large insider allocations are often a huge red flag for concentrated power and influence down the road. And finally, identify the infrastructure dependencies. Does the main wallet for this chain rely by default on a single company's nodes, like Infura? Is all the critical code hosted only on GitHub? Where are the potential single points of failure that contradict the decentralization narrative? And if you're a developer, someone actually building in this space, these lessons are maybe even more critical. First, please, build with resilience in mind. Don't just take the easy path. Actively look into and, where feasible, integrate genuinely decentralized alternatives for your infrastructure. Maybe use Radical alongside GitHub. Explore decentralized RPC providers. It takes more effort, but it builds a stronger foundation. Second, try to avoid hard-coded dependencies. Design your dApps or wallets so they aren't locked into a single infrastructure provider. Offer users choices if possible. Let them point your app to their own node or to alternative providers. And maybe most importantly, practice transparent communication. Be honest with your users. If you've made pragmatic trade-offs towards centralization for performance or usability reasons, which is often necessary, just say so. Explain the trade-offs. Don't hide behind the decentralization buzzword if the reality is more nuanced. And lastly, for regulators trying to figure out how to approach this space, the key takeaway is probably to focus on the identifiable choke points. Instead of trying to regulate the decentralized protocols themselves, which is incredibly difficult, focus regulatory attention on the clear intermediaries where centralization has reemerged. This means focusing on the centralized exchanges, the on-off ramps, the large custodial wallet providers, the major stablecoin issuers, and maybe even critical infrastructure services like the large node providers. These are the points where traditional regulatory tools can actually be applied effectively, because they look and function much like traditional financial intermediaries. Look, the cryptocurrency ecosystem is clearly at a fascinating, maybe pivotal moment. The path of least resistance, the one driven by market forces and user demand for simplicity, seems to be leading towards a kind of hybrid future. In this future, we might have these genuinely decentralized base layers, like the Bitcoin blockchain itself, acting as settlement networks. But almost all interaction with them happens through a layer of convenient, efficient, but ultimately centralized services built on top. Now, this outcome, while maybe practical, maybe even inevitable, it fundamentally challenges that original cypherpunk dream of pure decentralization and disintermediation. It implies a world where most users will continue to trade away sovereignty for usability, where power doesn't disappear, it just shifts potentially to a new generation of dominant tech companies and financial platforms operating in the crypto space. Understanding this paradox, understanding the reality of pragmatic centralization, is absolutely essential, I believe, for anyone trying to navigate the future of finance, the future of the internet, and the role crypto will play in it.
That was a really, really insightful deep dive. It certainly makes you pause and think about those trade-offs we make constantly, often without even realizing it, trading away bits of control for convenience, and just how powerful those market forces are in shaping even revolutionary technologies.
Indeed. It leaves us with some big questions, doesn't it? If what we see in most major projects today is this pragmatic centralization, then what does true, uncompromising decentralization actually look like? Is it even achievable at scale with millions or billions of users? Or is this compromise, this hybrid model, simply the inevitable reality we need to learn to navigate and perhaps regulate smartly?
That is a fantastic question for all of you to mull over. Thank you so much for joining us on this deep dive. Until next time, keep digging for those nuggets of knowledge.